Picture this moment in the market when prices don't just move, they snap. When traders who thought they were in control suddenly realize the math has turned against them and the exit door is far smaller than they imagined. That is exactly what a gamma squeeze feels like. And right now, the silver mining sector is flashing the early signs of one, with miners jumping more than 8% in a single move as an options expiration trap quietly springs shut beneath the surface. To understand why this matters, and why it could be only the beginning, we need to slow everything down and unpack what just happened in plain language. A gamma squeeze is not hype, and it is not magic, it is mechanical. It comes from the options market, where traders buy and sell contracts that give them the right, but not the obligation, to buy or sell shares at certain prices by a certain date. The key players here are market makers, the institutions that provide liquidity by taking the other side of these trades. When a large number of call options are bought on a stock or sector, market makers often hedge their exposure by buying the underlying shares. The higher the price moves toward those call strike levels, the more shares they are forced to buy to stay neutral. This feedback loop is called gamma, and when it accelerates, prices can rise very fast, not because of new bullish news, but because of forced buying. Now layer on top of that something called OPEX, short for options expiration. This is when a massive number of options contracts expire at the same time, typically monthly or quarterly. Leading into OPEX, price action is often pinned or suppressed around certain levels where the most options expire worthless. This benefits option sellers and market makers because worthless options mean maximum profit for them. This is why you often see strange price behavior right before expiration, where assets seem unable to break above obvious resistance. Traders sometimes call this an OPEX pin or an OPEX trap. In the silver miners, that trap appears to have just failed. As prices pushed through key levels, market makers who had been leaning short gamma were suddenly forced to hedge aggressively. That buying pressure doesn't politely wait. It hits the tape immediately. This is why you can see a broad basket of silver mining stocks all moving together up 7, 8, even 9% in a short window, despite no single company releasing earnings or discovery news. The move is structural, not narrative-driven. This matters because silver miners are a leveraged play on silver itself. When silver prices rise modestly, miners' margins can expand dramatically. Think of it like a fixed cost business. If it costs a miner $20 to produce an ounce of silver and silver sells for $22, the margin is thin. But if silver moves to $26 or $28, production costs don't double, profits do. This is why miners tend to outperform the metal during bullish phases and underperform during bearish ones. Add a gamma squeeze on top of that natural leverage and you get explosive moves. Zooming out, silver has been coiling for years. Unlike gold, which has already made new nominal highs in recent cycles, silver has lagged. Historically, this is normal in the early and middle stages of precious metals bull markets. Gold moves first as a monetary asset, driven by central bank buying, currency debasement, and geopolitical risk. Silver follows later, often violently, as investment demand collides with industrial demand. Silver is both money and metal. It is used in solar panels, electronics, medical devices, and electric vehicles, while also serving as a store of value. That dual role makes its supply and demand dynamics uniquely tight. Right now, the silver market is facing persistent structural deficits. Annual industrial demand has been setting records driven largely by green energy and electrification. At the same time, global mine supply has struggled to grow. Many of the world's largest silver mines are aging, grades are declining, and new discoveries have been limited. Unlike gold, silver is often mined as a byproduct of lead, zinc, and copper operations, meaning its supply does not respond quickly to higher prices. You cannot simply flip a switch and produce more. This is where miners come back into the story. When the physical market tightens and the paper market is heavily positioned, even a small spark can trigger a repricing. The options market is that spark. As calls pile up and puts get crowded, the balance of risk shifts. Once price breaks above key gamma levels, the same forces that held it down now push it up. That is what we are seeing now. The 8% move is not the destination, it is the signal. Think of it like compressing a spring. Every month, price is pushed back toward the same levels at OPEX, pressure builds. Traders get comfortable shorting rallies. Volatility sellers collect premiums. Then one expiration arrives where the pin breaks. The spring releases. The first move feels shocking, but it is often just the start of a broader trend as positioning resets and new participants. Russian asking the same question, how did I miss this? BR history offers useful parallels. In the late 1970s, silver lagged gold for years before exploding higher. In 2010 and 2011, silver miners and silver itself went nearly vertical once momentum turned. More recently, smaller squeezes in individual mining stocks have shown how thin liquidity can amplify moves when options positioning flips. The key takeaway is not to chase blindly, but to recognize when market structure changes. Another critical point is sentiment. For years, silver miners have been ignored, underowned, and dismissed as dead money. Capital flowed into technolo, GY, growth stocks, and crypto. Precious metals equities were left behind. That creates the fuel for outsized moves when attention returns. Markets rarely reward crowded trades. They reward patience at turning points. When you see miners all moving together on no news, pay attention. This brings us to the bigger picture. A gamma squeeze is not a long-term thesis by itself. It is a catalyst. It forces prices to reprice quickly, and in doing so, it can wake up investors to underlying fundamentals they have been ignoring. If silver itself begins to break out, miners can enter a sustained uptrend, not just a one-week spike. That is when generalist funds, momentum traders, and even retail investors start to participate, extending the move far beyond what early positioning alone would suggest. So the real question is not whether miners are up 8%. The real question is what happens if silver pushes through major resistance levels while options positioning remains skewed and physical supply remains tight. What happens when shorts realize they are leaning against a market with both structural deficits and forced buyers? What happens when the OPEX trap no longer works and volatility returns to a sector that has been artificially calm for far too long? Because